Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon daily webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Dimitri, Market Chameleon, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows and webinars, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonik to the stage. We'll discuss understanding options, historical skew, and time spreads. Welcome, D. How you doing, buddy?
Good morning, Will. How are you?
Great. Let me share your screen, and there was the beautiful Market Chameleon. All right, we're ready to go.
Good morning, everyone. Let me go to my screen. And what we'll do today is look at a tool that allows us to plot a chart of the relative cost of an option in one maturity versus another. So we'll do like something like a 60-day maturity option versus a 30-day maturity option. And first, let me navigate to it, and then we'll discuss this tool. And let's use Google in our example. So I'm going to go to Google by typing in the symbol in the search box, clicking enter. This will take us to the Google main summary page, and on the left-hand side, we're going to go and click on options on the menu, and then slide down to I think it's under volatility. Under the volatility, we see risk premium. So we're going to click on this, and this will bring us to a tool that allows us to chart risk premium for the symbol that you're on. I'm going to click on this menu to minimize it. And what we want to do here is we're going to compare the cost of an option in one expiration versus the cost of an option in a different one. And we can't, we could look at the difference in the implied volatilities, the implied volatility, let's say in a 30-day option. And so we have a 30-day option compared to the implied volatility of a 60-day option. But that doesn't necessarily give us a complete insight into the cost of those options. So let's say if I have an option that's 3 volatility, right? The implied volatility is 3 in the 30-day. And let's say on the 60-day, the implied volatility is 6. Well, the difference between the two is 3 vol clicks, right? If I take 6 implied vol minus 3 implied vol, I get 3. If in that same option, right, let's say the 30-day implied volatility is 100, and the 60-day implied volatility is 103. Well, if I take 103 minus 100, I still get the 3. So the implied volatility difference is still 3. But there's a big difference in the cost of that option, because when you go from a 3 to 6 volatility, you're talking about twice as much. From 100 to 103, it's a 3%. So when we start taking implied vol minus an implied vol, it could be deceiving because we get this number, but the level of the implied volatilities are going to matter, right? So even though we're taking one, subtracting it from the other, and then we get this one number, but that doesn't really reflect where the level of those implied volatilities are at that moment, right? Because we just get this number and it's 3. So another way to look at it is, what if we converted the options value to a relative cost? Well, what does this option cost me? Where we're at the 30-day, and what does it cost me relative on the 60-day, and how do I kind of normalize that cost? So I could compare it over time. I could compare it across different securities. So that's the first thing we need to do, kind of to establish our metric to compare. So right now, we have this chart. So we could look at a 30-day, gives us a drop down. We could look at and then compare it to, other maturities. And to get the cost, so right now, this is the cost of a 30-day at the money put. Okay, this is a chart of just one 30-day at the money put. And if you notice, when we look at the premium, we're not looking at the implied volatility of it. Here, we're looking at the relative cost of this put. Okay, so for a 30-day put, we're doing it in percentage terms, right? It's gonna cost around 3.4% of the at the money, right? So whatever the at the money is, it's 3.4% of that to hedge your risk, right? So think of it as like, an insurance policy. It's like so for every $100 you want to insure, it's $3.40. Okay. You want to insure 1,000, it's $34 and so forth, right? So that's kind of how you think of it. We're doing it in a percentage terms. If you want to convert it to dollar terms, for every $100, $3.40. Okay. So if the stock is 246, you multiply it, 247, you multiply 3.4. So that's the cost of the put, 3.4. So we know in percentage terms, we could keep track of it because it's a percentage of the spot price. Well, now that we have that, right, we could see it changes over time, got up all the way up here, over 5%, got as low as over here, I don't know, 1.7%. And this dotted line over here is the average of all the values. We could do at the money, we could do out of the money, the same thing for calls. We could do an at the money call, which is on the spot. We could do an out of the money call, like say 2% away or 5%. So as long as we have, that the metric that we're trying to measure, and we use the methodology over time, we could track it. So we could also look at, let's say not compare, we could look at a 60-day. Right? Let's say we look at a 60-day at the money put. We reloaded. And you could see here that a 60-day, it's going to cost more because it's further out. You have more time premium, right? So here, the cost, an average is 3.7. Right now, it's 4.3. So now we have this 60-day put, and it also moves around. It got as high as like up here, 6.6%. It looks like it got as low as like 2.5%. So it fluctuates around, and there's some kind of a relationship between the premiums when we look at a 30-day and a 60-day. So let's say we took the 60-day and we wanted to compare that to the 30-day. We wanted to compare, well, what was the difference between the two? So if I took the 60-day put, right? So here's the chart, and I wanted to compare it to the 30-day, and for each one, I wanted to compare the difference in the cost. How much more would it cost if I took the 60-day and the 30-day? How much more did it cost me in premium for the 60-day in total premium? So we're going to add a comparison, and we're going to look at the 30-day. Of course, we could change these, but we're going to look at we're going to keep them both for the at the money put. But what we're doing is comparing different maturities, a 60-day versus a 30-day. Okay, so wherever you have here selected, it's going to be the first one minus the second one. That's what we're going to compare. So we're going to reload that. So here you see here 60-day. It tells us here 60-day at the money put minus 30-day at the money put in the cost, not implied volatility. Remember, we're comparing the cost of the put. So here, now we have a chart, and you can see it fluctuates around, gives us the difference, right? So right now the difference is 0.89%. Okay, so if I buy the 60-day put, sell the 30-day, it's going to cost me in premium 0.89% of the spot price. Okay. Compared to the average, the dotted line of 1%, 1.02%. Okay, so we see we're below that. We got as low as, over here, 0.5%, it looks like. Maybe again here, 0.5%. But we see some high ones over here, 1.86, 1.76. So it fluctuates around. Now we have an idea of the time skew. We have an idea of where we're at now, right? So where we're at right now over here. We see how far away we are from the 52-week average, because that's that dotted line, that dotted orange line. All right. We also see how much it how it fluctuated over time, where how where the high and low ranges were. Right. So right now we're closer to the average, below, but we've seen how high this got in the past, and how low it got in the past. So now, really quickly, what this chart allowed us to do was compare two maturities in a standardized way, 60-day, 90-day. We kind of normalized it to the cost of the options, right? The relative cost of the options. And we're able to plot one versus the other, the differences over time, so we could get quick insights. How did this relationship behave historically over time? How did it fluctuate? What were the ranges, the highs, the lows, and what is the average, and how far away do we move away from the average? All right, and where we are at now. So this tool gives us a quick insight into that time spread using a different methodology than just an implied volatility. All right, well, I'm going to throw it back to you.
AD, great job. Another great webinar in the daily webinar series. Thanks for bringing it to the Chameleon community. Our next webinar will be tomorrow morning. Thanks for doing it, my friend.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day, and we hope to see you tomorrow.
All right, D. We'll see you tomorrow, my friend. Thank you for bringing these to us. Bye-bye. Hey, everyone. Thanks for joining our webinar series. I know since yesterday you were on and asked if yesterday's webinar, if you were in the right place, and you were. Yesterday was a pre-recorded webinar. When we send those out, the chat is actually live during the webinar, so everyone can get on and chat. So I'll do that every day. Plus, I'm doing now a weekend webinar series. So if you click on that if you click on that email and go on, you can also chat live during those webinars. But those are all pre-recorded. Thanks, everyone, for joining. Rob, I just see you came in. Welcome. I don't know if everyone saw, Mike is going to a Schwab event, a learning event. Actually, it looks like near Miami, Mike. That looks like if any chameleons wanted to go and join him, that would be a fun activity. And I'm wondering if Mark Chameleon should actually show up and host a meet and greet at a bar next door. Unfortunately, I think I have stuff going on that weekend, so I can't go. But Swami, you may want some warm weather, maybe get down. For anyone who's not a regular on our show, please check out Market Chameleon. You can get a 7-day free trial. Just click on Start Free Trial on the homepage. I don't know what everyone thinks about the new homepage, but Dimitri and the developers worked hard on that. And so far, the feedback has been mostly positive, but with any changes, you do get some mixed reviews. But with that, everyone, you have a great, safe trading day. and hopefully we'll see you tomorrow. Enjoy. Bye.